we are this morning going to be doing our second run of succession seminars. First one was introduction. Today we're going to go more into what happens afterwards to give you a bit of an idea of what today's about. So you've all sold your company's businesses for tens of millions of pounds. You're now sitting on a load of cash, and what are you going to do with it? And that's the problem that a lot of our clients have. And we're going to talk about some of the solutions and what you need to be thinking about and when you need to be thinking about it as we go forward. So today we've got some information about Myerson. We don't have to go into too much detail about that. You got these people. So you got myself. I am a partner in the corporate team. I've been spending 15 odd years doing private wealth as a corporate lawyer. Been doing family investment companies, I think before they were called family investment companies, but having lots of fun with them. Clara, my partner in the Wills, Trust and Probate team, is going to be talking about death, unfortunately, and planning for death and wills and trusts and exciting things like that. And then our very good friend, Laura Hutchinson from Forbes Dawson, is going to be coming and talking about family investment companies and mainly the tax around it. We've been working with Forbes Dawson with family investment companies for nearly 10 years probably. Lots of various clients, lots of size, different clients, lots of different values. And the thing we really get asked most about family investment companies is what the hell are they? How do they work? I've got clients in the room today who have a family investment company and they still have questions about how they work. So hopefully we'll help solve it. And if anything, give you enough information to start pointing our way. As I know there's a lot of financial advisors here to come speak to us and then ask questions. So without any further ado, I'm going to, the agenda for today, we're going to talk about some lifetime giving, try to explain trusts for those in the room who don't really understand it, and fair enough, they are complicated. I'm a corporate lawyer, I'm not a trust lawyer. They're not easy to get your head around. Then we're going to talk about family investment companies, and then we're going to talk about wills. So, Clara.
Thank you, Scott. Hello. And thank you for coming along to listen to us this morning. So, clients exited a business. These are some of the concerns that they might have. Inheritance tax, retirement planning. They might be at the retirement age, they might be a long way off, but planning for that stage is something that clients always want to talk to us about when they're in this situation. Passing assets down to children and... Sorry, you can't hear?
That's not switched on. If keep it closer to...
Is it on? Yeah. It is on. I'm not using it properly. It feels like I'm in a karaoke bar at the minute. Right, okay, well, just shout if you can't hear me. So passing assets down to children and future generations, possibly assisting children, buying properties, getting set up in life. Perhaps they want to set up a business of their own. Protecting wealth for future generations. Often people are concerned about possible claims from third parties, and protecting assets for the family. So we're going to talk about some planning opportunities outside the will first. So during your lifetime, you've got cash, you want to move it out of your estate. One of the most common things people will do is lifetime giving. So gifting out of your estate for inheritance tax, you need to survive the gift by 7 years and you can't retain any benefit in it. So you have to give it away. You can't have your cake and eat it. Gifting cash, obviously, it's easy to gift the cash and not retain any benefit. Obviously, problems can occur if you're trying to gift property. Doesn't mean you can't gift property, but there can be capital gains tax implications, things that we need to consider. There's also maybe issues about retaining benefit if people want to retain income, or it's a holiday home that they use. All things that we can deal with, but it's just a bit more complicated. It's more simple if you have cash to give. There are additional rules for gifting into trust, and we're going to come on to talk about trusts in a moment. Gifting to individuals is obviously quite straightforward. There's no trust compliance, there's no extra rules that you need to worry about, but there's no asset protection. So a lot of people are a bit concerned about giving large sums of cash to children and other beneficiaries in their hands. Once it's theirs, they can do whatever they want with it. It will be inside their estates for inheritance tax purposes and other purposes as well. So the other option that people want to look at is giving to trusts. Some people are a little bit scared of trusts, nervous about trusts. They do come with some complications and compliance, and there is taxation rules that we need to discuss, but trusts really do have a place in planning. So just some basics for those that perhaps aren't familiar with trusts. With a trust, you are separating out the legal and beneficial ownership. The trustees are the legal owners. They're the people in charge of the assets, and they will manage those assets in line with the terms of the trust. There are a number of different types of trusts. Mainly what we're going to talk about today is fixed interest. So you will have trusts where the beneficiaries have a fixed right. So most commonly, you might have an income beneficiary. They may get that income for their lifetime, and at the end of that period, the capital goes to different beneficiaries. That's fixed interest. You know who's getting what. You also have discretionary trusts, and that they are a bit more flexible, but it's completely to the discretion of the trustees. So we're going to talk a little bit more about discretionary trusts later on. As I say, there is tax to consider when gifting to trust. There's an immediate charge to inheritance tax of 20% when gifting to trust in your lifetime. The charge is only on anything over your nil rate band of 325,000. So, but don't let that put you off, because there are ways of doing things, and people like Laura, we do work with people like Laura on lifetime trusts. There is a tax regime for trusts, but it's still a lot less aggressive than the 40% on death. And then your other option, when if you don't want to gift to trust, you can make a loan. So you're loaning to trust. The loan obviously stays within your estate, but it means that if people are a bit concerned about, they don't want to completely give money away, then you can always call back some of that money if you need it. But the growth, importantly, is within the trust wrapper and won't be within your estate. So over an amount of time, loan trusts can be really useful. So that's a bit of an introductory section from me. I am going to come back later to talk about trusts in a bit more detail and planning in your will. But I'm going to hand over now to Laura, who's going to talk about family investment companies.
Thanks, Clara. Can everybody hear me? Thanks to Clara. She just talked about loan trusts, which is a really good introduction to what I'm going to talk about here. They may look very different to a loan trust, but conceptually, as Clara explained, the concept of a loan trust is you are putting money into a vehicle, which is a trust, and you are owed that money back. And it's only the growth in value that falls outside your estate, which is very similar to what we're trying to do with a family investment company on a simple basis. Mum and Dad would set up a company which is going to be used to make investments. They would loan a lump sum into that company, and they would be owed that money back. So at that time, we're not making any inheritance tax savings. Family investment companies are known for being very good vehicles for inheritance tax planning, but that at the outset, when you first set the company up, you've made no saving, because the money you put in is what you're owed out. The whole concept is about capping the value in your estate and not allowing any further growth to accrue to you. So this is a typical type of structure we have for a family investment company. And I have to caveat that family investment companies are really only useful as long-term vehicles. These are not vehicles you're going to have for 5 years and wind down. They are sort of 30, 40 years of vehicle. They are, the way we set them up, it's a very flexible structure that allows for you to benefit members of the family longer term. So you're talking about children, grandchildren, and future grandchildren. That's the whole point of the flexibility we offer on this kind of structure. So in contrast to loan trusts, which you say, well, why not use a loan trust? It seems much simpler to me than this convoluted structure we've got here. The reason being that companies and the structure we've got here have more tax advantages throughout the running of the company than a loan trust would have. When you're receiving interest or income and dividends into a loan trust, you're taxable either directly on the beneficiaries or at 45% rate of tax in some cases. Whereas with a company, the whole benefit of this is you're able to accumulate income growth in the company whilst only paying relatively low rates of corporation tax. Of course, the corporation tax rates unfortunately have increased recently from 19 to 25%. It's not quite as lucrative as it once was, but it still is tax efficient if run properly. So going back to the structure as a whole, if we go back to basics, the company's set up by mum and dad. They put £100 into each trust, and the trust subscribes for ordinary shares in that company. Those shares are worth nothing at day one because there's no value in the company. The money in the company is contrasted with a loan owed back to them. The mum and dad can charge interest on that loan if they want to be able to get an income from the company. That entirely depends upon the circumstances of the individuals themselves, whether they need the income, whether it would just add extra income tax on their liability, or whether they're at retirement age and they can structure their income how they want. They may be at a stage where the only other income they have is state pension. They're not drawing down the pension yet. They may be able to get dividends out of other family companies, but choose not to in certain years. So we've got the flexibility here of getting some interest out of the company, which is, we'll come on to how tax efficient that is for mum and dad if it suits their circumstances. And of course, the company then invests in whatever it wants to invest in, typically stocks and shares, properties, residential, commercial, not properties that the family want to occupy. I have to caveat that. But we often ask clients, often ask, can I put the flat in London in there that we all stay in? No is the answer to that. So it's very much for income and capital growth assets that are going to provide an income to the family members. Mum and dad, and Scott's going to talk a lot more about the sort of the share structure, but just to say that mum and dad, in the examples we do, typically don't have shares that accrue any value. So they are just either voting shares. They might be able to get a dividend, but we tend not to do that. They're just really there to control that company with the votes that they have. And of course, crucially, the control point is very key for most clients. They will also be trustees of those trusts as well. So mum and dad will have 100% of voting rights over the company. They'll be directors of the company, so nobody can do anything they don't want to do. That's the control angle sorted. So I'm going to delve more into the taxation running of the company. How is it taxed as a corporate entity, and how do the family get their money out of the company? Because crucially, that's what we're looking at, isn't it? Benefiting members of the family. So we can't hide it, we've got two layers of taxation. We've got the corporate level, and then we've got the distribution level. So sometimes, for some people, it's better to hold assets directly and just receive the income in their own name. But for some people, it's better to accumulate the money in a company and just take out what they need. For clients who tell us that, oh, I've got this property rental business, I want to put it into a company, but I need all the rents, this is not a structure for them because they're going to be paying higher rates of tax than they would otherwise have paid just receiving the rents directly. So this is for people who are happy, they've got enough wealth to put it into a company, to let most of it accumulate and just take out what the grandchildren need and maybe what the adult children need from that company. So at corporate level, we've got corporation tax rates of 25%. If we're talking about a company that has stocks and shares in it, there's no marginal relief, there's no 19% at all, it's all 25%. Because it's a close investment holding company. And that's if it's a property rental and your profits were under 250, you might be able to get some at 19%. But let's just keep it at 25. However, the good news is that if you're receiving dividends in a company, they are exempt from tax. So in a typical portfolio of stocks and shares, you'd have some dividend producing investments and some interest producing investments. So those dividends will be tax free. So that brings the overall effective rate down significantly for the company. Any gains realised on sales of investments, 25%, let's say. But if you have a property company and you're geared up, you've got lots of mortgage interest, you are able to get a full deduction for that, even if it's residential property. So compare that to the individual residential landlord who can only get a 20% tax reducer on your mortgage interest. The company gets full relief at the corporation tax rates. Interestingly, it also gets relief for any interest paid on mum and dad's loan as well. So 25% relief against the corporation tax on any interest it physically pays out to mum and dad. When I say physically paid out, that's important because we often have an interest-bearing loan, and we may have it interest-bearing from day one, but we know mum and dad are still working for sort of 5 years. But we will accumulate that interest and not pay it out until year 6 when they've retired, and they can receive that interest in year 6 when they've been taxed on it much more efficiently, rather than having it as a top slice of their income. So you can switch interest on and off. You don't have to take it out. If you don't take it out, though, you don't get a deduction in the company. So it's all about timing of the interest. Then going to the top layer where we're talking about how do we extract the funds. So what we would recommend is that, we have different classes of shares, A, B, C, D, E, so dividends can be paid on whatever class you want. So if, let's say, grandchild number 1 needs some money for school fees, a dividend can be paid out on that class of share through the trust structure to them. And they would receive that and be taxed on that at their rate of tax. Dividends are obviously the only way you can get money out for the various investors, except for mum and dad. So you can't get any capital out. It's always going to be income, so it's going to be dividend income. So you need to understand the rates are from 8.75 up to 39.35. Typically, you wouldn't be paying out people dividends at 39.35%. You'd be paying it out to the younger members of the family who've got personal allowances, who've got lower bands available. You get £50,000 out at a very, very low rate. It's obviously less than 8.75 because you've got 12,500 at 0%. So it's pretty tactical. The dividend rate at 8.75 is very low. Interest on loans, that's mum and dad. We talked about getting interest out from the company, corporation tax deduction, tax in their hands. So if they are a basic rate taxpayer, or I'll come on to later on how sometimes they can be paying tax at 0% on interest, that's a really tax efficient way of getting money out of the company. Loan repayments is the main way that mum and dad will get money out of the company though. They'll get capital loan repayments as there's liquidity in the company or as and when they need it. The loan is always repayable on demand, and it's really important for tax reasons, it's repayable on demand. So they can call on the loan whenever they want. I mean, ideally, they're not going to call on £1 million in the first year because that's going to obviously stop the growth occurring to the company that they need. But they can call on it, and that's tax-free in their hands. Now, that's really the crux of the inheritance tax planning because, as I said, at day one, they've got the full value of the loan in their estate. The idea is that they basically take this money out of the company and spend it. And as they do, their estate diminishes because that capital loan is reducing. That's the whole premise of the tax planning. And then ultimately, in year 30, 40, whatever it is, or maybe when Labour get in, I'm joking, but close the company up, close it down, wind it up, pay capital gains tax rates on any growth in that company. I say any growth, that's assuming you haven't money boxed, which is basically accumulating all your profits for years and years and years, not taking anything out. The revenue might have a problem with that. But if you've taken some dividends out, allowed some growth to accrue, you're then able to take your profits out at 20% on the ultimate liquidation of that company. Now, it won't be mum and dad who get that. It'll be the trusts or the children who own the shares. It'll be their wealth. But that won't happen until mum and dad say so or until the children are old enough to be managing the company themselves. So these are the, one other thing I've not mentioned there is the substantial shareholders exemption. And that's basically where the company owns enough interest in a company, more than 10% in a trading company. So let's say son Johnny wants mum and dad to invest in his trading company. They may do that through the family investment company, and as long as they hold more than 10% of the shares, if and when that company is sold, the tax in the company's hands will be tax-free on the sale of those shares because substantial shareholders exemption applies. So for the shareholders themselves, we can manage the flow. That's the key point here. If no dividends need to be paid, no dividends are paid. It's just controlled as and when people need the income. Capital loan repayments tax-free. Interest on loans, the beneficial rate of 0%. So this is, I don't know if you're all familiar with, but most people who are not additional rate taxpayers, they will receive £1,000 allowance against interest. And this was all done for pensioners, so they don't have to pay tax on their savings income. £1,000 allowance. And if you structure your income correctly, you can also get up to £5,000 starting rate band. And this is, again, for pensioners who basically might have £12,000 of state pension. And then the next tranche of income they get is their savings interest. And then they may have some dividends on top. And importantly, dividends are always taxed as a top slice of your income. So the important point is that the interest is your first tranche of income over and above your personal allowance. And if it is, you can get up to £6,000 at 0%. So if mum and dad were in a situation where they had a property rental company, let's say, for many years, they got state pension, and they could basically take dividends from their company if they wanted to, and they didn't have any other income, they could take interest from this company and get 6,000 or potentially 5,500. The £1,000 is reduced if you're a higher rate taxpayer. So let's say £5,500 of interest tax-free, and still get a whacking great big dividend as long as it doesn't take them above higher rates. So that's the benefit of this. If most people are putting cash into this company, so the point made there, if you borrow from a bank to invest in a company, you may be able to get some interest relief on the borrowings. That's not as relevant, because if you're going to set this structure up, it means you've got a lot of cash, so you're not going to be borrowing from a bank. What's often forgotten about is that you are able to make pension contributions for those family members as well, provided they're either employees of the company or directors of the company. We typically recommend them to be directors, because it's, you've got a director's role there and you've been paid accordingly by a pension contribution being made on your behalf into your pension directly from the company, up to £60,000 a year. That gets corporation tax relief in the company, and of course it's tax exempt in their hands. And then just a point there that even if the company's entirely residential property in there, it doesn't matter. It's still a 20% rate of CGT when you wind that company up. So we look at an example here of the structure we had before. What I haven't covered is the trust point deliberately, because it complicates things a little bit in terms of explaining it. But the way we set trusts up is that it's a life interest, like a fixed interest, like Clara was saying. And that means that each child that is alive at that time, or grandchild, is entitled to a fixed share. So it might be that son Johnny gets the dividends on A shares and Philippa gets it on B shares, or whatever. It might simply be they get 50% of the income from the trust. So if no income is declared, they're not taxed on anything. But the way we do it is mandate the income out to the beneficiaries, which saves the problem of having to do a trustee's tax return form, get credits for tax and give them the tax credits. It's just much simpler. We can just pay it directly to them. They get taxed on the dividend at their rate of tax, which for typically the grandchildren will be 8.75% or lower. We've talked about the bank interest, and the capital loan repayments, again, it's just to reduce their estate. They should be taken if the family want them. That's the whole point of the inheritance tax plan. They don't leave it in there long term. Also, when you crunch numbers, it's often better to pay some element of salary or bonus or something like that that reduces the corporation tax rates. It's all about crunching numbers and the circumstances of the clients. What is useful to understand, though, is the reason why we don't say that mum and dad should have dividends on their shares is because it's much more tax efficient to get the interest. This example here assumes that the scenario I described before, where mum and dad have got another property company and they take some dividends out, means they haven't got their dividend allowance. So if they were to take a dividend, the company would receive profits of £10,000. It would have to pay corporation tax, because paying a dividend doesn't attract any corporation tax deduction. So they pay 25% on that income, paying £2,500, leaving £7,500 to distribute by way of dividend, which will be taxed on mum and dad at 3.75%, the higher rate taxpayer. So that would be 2,531 of personal income tax. If we add together the corporate and the personal tax, we can see that the effective rate is 50.31%, £5,031 of tax paid overall. Now, normally, we're not concerned about what the company pays in a non-family company, but of course we are concerned here because this is all family money, so we want to know what the effective rate is. If, however, they were to pay interest out instead, then the company's got £10,000 of profits. They're able to pay out the full £10,000 because they're getting a deduction for CT, so there's no corporation tax payable. And mum and dad would get their £500 interest allowance against that and be taxed at 40% on that receipt. Total tax, £3,800. So you can see the difference there between the 50% rate and the 38% rate for the interest. Now, of course, if they had that £5,000 allowance as well, we'd be in an even better position for mum and dad. So it's just about the circumstances, about controlling income where possible for the clients. So the main reason why people do family investment companies is not all that, it's the inheritance tax planning. And the main benefit of a family investment company is that you're able to spread the wealth of the company between the various members of the family. Now, we're spreading it between trusts because we believe trusts are much more flexible than individuals owning shares in their own name. Because if they give the shares to adult children, they're going to end up being older one day and have all the value in their estate, and they've got the same problem again. Whereas if you use trusts, you can basically pass that wealth down to the next generation, etc., without making gifts or without making CGT disposals. So it provides a lot more flexibility if you set it up right from the start. So when I've said there's no gift, usually there's no gift because you've got no value in the FIC at the start. You are basically setting it up with a loan, so there's no value. The £100 into trust is nothing, is it? It's in the £3,000 exemption, so there's no gift there. You can, of course, give shares to individual family members if you want. It just doesn't provide the same level of flexibility. And the point is the wealth flows into the trust estates gradually as the wealth grows in the family. And we talk about values of shares in trusts in just a second, but that's really how this structure really comes into its own in terms of inheritance tax planning. Trusts also offer some elements of asset protection, as Clara said. We can't categorically say it will protect a divorce, but it is helpful, more helpful than shares in direct names. And 10-year charges, if you have individual ownership of shares, no 10-year charges, but there is if you use trusts. So you need to be aware, and this is why when we tell clients about these structures, we go into a lot of detail about the long-term use of the structure and what charges will apply to the trustees in year 10, 20, 30. So, but we are doing as much as possible to mitigate those 10, 20, 30-year charges by the structure of the trust from day one. So we could set up one trust and have lots of different beneficiaries in it, but we don't do that because we set up multiple trusts in most cases, because then we have a smaller amount of shares, smaller number of shares in each trust, which means that the value of those shares in each trust is low. So if there's 10% in trust 1, 10% in trust 2, all the way to trust 10, you've got a pro rata value, 10% of the company in each trust, and not only that, you also get a huge discount because you've only got a 10% interest. So I wouldn't pay somebody 10% of the value of a company to own 10% of the shares. There would be a discount applied to that value because I can't control that company, I can't wind it up. So typically a 70% discount can be applied to a 10% interest company. So you're losing into the ether, for tax purposes only, 70% of the value of the shares just goes and doesn't get taxed to inheritance tax. Scott's going to talk more about returns. I'm not going to go into details there about the types of shares that can be held by the trust of the individuals, mum and dad, etc. But typically, the trust would own ordinary shares, giving them a right to capital, rights to dividends, and voting rights as well. Because don't forget, the voting rights are owned by mum and dad as trustees, so the control is still there. If we compare owning property in an investment company compared to owning it directly, these discounts I talked about are really key here, because if you own a property jointly in your own name, let's say mum, dad and 2 children own a property, the maximum discount they would get on their pro rata interest is 10%. Whereas if you own shares in a company, you can get up to 70% discounts on those shares for inheritance tax purposes. So this is the table of the discounts, I won't go into that. So when we're talking about trust, we say it works best with multiple trusts, and where we are subscribing for a low amount of shares at day one, no value, and then, I won't go into technical detail, but basically this allows each trust to have an allowance against the 10-year charge to inheritance tax. Now, the 10-year charge is only 6% to the value that's in the trust, but if you've got huge discounts applied to your shares, and you've also got an allowance of £325,000 against any inheritance tax in each trust, more or less, that significantly reduces your inheritance tax. Now, to go back to the loan trust route, which we've started by comparing, that's not possible with a loan trust. In a loan trust, all the value is in one trust, and you're going to be taxed at 6% on that growth at 10-year charges. Whereas with multiple trusts owning shares like this, big discounts, allowances, multiple allowances, hence lower rates of inheritance tax. I think that's me done, I think, isn't it? Pass on to Scott now about returns and how we achieve all that.
Thank you, Laura. The legal bit, that's me. So I'm just going to pick up a couple of points Laura's already talked about. So the alphabet shares, share rights, explain a bit about them, control, which is the biggest question we always get asked about, who's in control of all this, and then finally the constitution of the FIC, what you can do with it. So first, just talking about some of the share rights. General rule, ordinary shares, 3 rights: voting, income being dividends, capital, what happens on the sale of them. You can put more in there, but that's what comes out of the box. As a lawyer, my job is to manipulate those rights, create different classes of shares, each share having a different right to achieve the benefits that we're trying to achieve. So typically, mum and dad, A and B shares, no capital rights. So that's the point here. We freeze the value of the shares. They don't get any benefit in the future growth of the company. So whatever they put in, debt-wise, that's it. They don't get any more. If the company was sold, they get £1 per share back. That's it. In relation to flipping that with the children in trust, capital rights, they get everything. So day one, loans in there. As the loan is repaid, growth increases in the assets that have been purchased in there. All the value goes to the children. Nothing goes to the parents. It slowly moves in that direction. Voting. This is a question we always have. We have a discussion every now and then with, depending on the advisors involved. Who has the voting rights? I'll come back onto the controller in a minute, but if you've got 2-3 children having a trust each, and we made the point about the trustees being mum and dad as well, voting is irrelevant because it's still the same two people making a decision every day. But I'll come back to it in a second. And then dividends. Laura's already mentioned about dividends. Does mum and dad have dividends? If they're taking interest out on the loans, they've got capital repayments to come back in, they're probably not going to need cash, but who knows? So what we often do is we have a discretion over the dividends, and we normally mix it up a little bit. So we kind of say, children can have a dividend if mum and dad as directors say so. But then if mum and dad are going to have a dividend, we'd probably want all the shareholders to agree to that first before the cash goes out to them, just in case there's a bit of greed going on. So it just adds another level of control. So the word control. Who is in control? Using the structure that we had before, do they come up with those guys? So in this arrangement here, there's like 4 different relationships. We've got the shareholders, we've got the directors, we've got the trustees, and we've got the bank. But the controlling party of each of those 4 is mum and dad. Mum and dad are individually a shareholder. They're also the trustees of the other 2 shareholders here, in this case. So they make all the decisions at shareholder level. Obviously, they've got fiduciary duties in relation to being a trustee. They've got to look after the best interest trust. But generally, it will be in everyone's interest. Mum and dad are going to be directors. Children maybe at a later date may come in as directors, depending on how well they are trusted by mum and dad to look after the money. But the directors will make the day-to-day decisions about where the money goes, what's going to be bought, what's going to be sold, where the money's going to be invested, how much loans going to be repaid. The Constitution sets all this out. And then mum and dad are bank. So they're the lender. If they want cash back, they ask for it. As directors, they're the borrower, they will repay it. So the control is completely there for mum and dad. Children. But a couple of clients come to me and said, I want to set up a family investment company. Great, let's talk about it. Oh, by the way, I've set it up. Me, the wife, 2 children, done the shares. Right, great. Scrap that, bin that company, dissolve it, it's useless. If you give children shares or let them enter into any contract before the age of 18, until they reach the age of 18, they can go back and decide, I didn't mean that. That contract was void. So anything they do up to the age of adulthood could be written off. Now, I've got 2 kids, 11 and 9, right? They can't decide on what they're going to do 5 minutes ago, let alone what's going to happen over the period of their 18 years. And if they fall out with you for any reason, you know what kids are like, you're going to have a problem. So this is the main reason. The tax benefits are there for the trust, but the absolute main reason is do not give the shares to the kids until they're at least 18. And still, you may want to have a question. Adult children. Are you going to trust your adult kids to look after your entire wealth in this company early on? Unlikely. Unlikely. What you're going to probably do is, and decisions about who's in control and everything like that, is something you don't have to worry about once it's set up. You can worry about this over a long period of time. We can plan for it in the wills, which we're talking about in a minute, but who's going to take over? It may not be your generation that are great with the cash. It may be grandkids that are good with the money. Maybe someone's done some economics degree and they are ready to step up. So as grandparents at this stage, you might go, you know what, skip my kids, we'll pass it down to Joey, let him run it. So the decision is later to be dealt with. But there are things you can do. You can bring them as directors slowly. You can give them more control, just see how things are going. I mentioned trust and trustees. Mum and dad are going to be the trustees. There are fiduciary duties legally. You've got to look after the beneficiaries. But as I said, if it's all about earning value and returning value, you should be okay, as long as you're not doing anything that makes one suffer the other. Wills and what happens on death, this is something you can worry about up to the very end. And it may not be you pass it down the control to the kids. You may decide you're going to put professional trustees in place and directors to run the FIC for the benefit of the kids going forward. So it doesn't. There's so many decisions and so many options, and it doesn't have to be decided about until much later on in life. Yeah, so that's the control point. To reach this control, we need to make sure the constitution of the company is set up correctly. This is the most important bit from the legal side. The Article of Association, and we'll come to shareholders' agreement and family constitution in a minute, but the Article of Association is basically everything you need to start with. The Article of Association will go through the share rights, it will set everything out and what share rights there are, who has them, and the benefits of all of it. Most of the clients will come to us and want to make sure the family investment company only applies to their bloodline. So mum, dad, their kids, kids, and only that way. If anyone joins the family, people get married, etc., and they leave, it's making sure the family investment company stays only, the shares in the company only stay with the bloodline. And the main reason for this is, let's say, family investment company is set up, father dies, mother remarries, do the children, the second marriage, if any, get to benefit from that family investment company, or should that wealth stay with the existing family and that bloodline? It's quite an old-fashioned way of thinking about it, but when you're setting up, you're doing it for your kids and their kids. So you want to really be thinking, having that control. So we make sure the Articles of Association are locked down to only those individuals in there. Even to the extent charitable trusts. You know, if you're looking to give some charity gifts, the family investment company may only be for the benefit of the kids, and we have to think about, okay, can we give any more out to charities? Can we look at other investments? So we need to think about who gets the benefit of the FIC very early on. We can change things, that's of course, but you know, legal fees and all that stuff. Transfer provisions mentioned, so we want to make sure permitted transfers, we allow transfers to be permitted without having to go to mum and dad. So we'll kind of say, well, okay, you get married, you can give some shares over to your spouse, benefit from the split. Again, all those lovely dividend rates, the lower the people are earning, the more cash we can get out to them and spread the money out and get it out with the company. But what happens if they separate? What happens if they divorce? What if they die? So we want to make sure there's automatic provisions to bring those shares back into the family investment company, mum and dad, so we can control them. Now, divorce is an easy thing to manage. There's values and there'll be cash that may need to change hands, but the shares should come back into the fold. And the Article Association do that. And then, yeah, cease to be a member to cover that off. Family constitution is an interesting one. We've had recently quite a few clients come to me and say, Scott, we want a family constitution. I was like, what the hell are you talking about, family constitution? And I've looked into it and said, it must be a shareholders agreement. And I was like, well, the articles do everything we need it to do, it's fine. But then I started reading up onto these family charters. And these really are for much larger families. I've got quite a few clients who have got family businesses. And that family business may have been run 30, 40, 50 years. And we've got 5 generations. And there's like 30 shareholders. And like nieces and nephews have been given shares. And everyone's been given it. And it kind of applies to that. But the idea is, number one is, who's on board? Who's allowed to be employed by the family investment company? Does any child that company born into the bloodline get to get a job? Probably not. Probably want a qualification level, you know, a couple of years of being involved before you get a job. What does the family investment company invest in? Are there any no's? Are there any certain businesses? I'm trying to think of examples that are good for a Thursday morning. I was thinking the Netflix show Gentlemen, you know, family business turned into a drugs den underneath a barn in the back of the farm. You know, you probably want to exclude that from the family investment company, wouldn't you, for future days? Chauncey's saying no, he's up for that. So it's about planning ahead, working out how the family works with the board, but really, early on, you don't have to worry about that. Mum and dad are control. They keep control until they decide to give up control. I think, yeah, that's all I've got to say on that. Back to class.
Thank you. So, wills, very exciting. You've set up your family investment company, you've done some lifetime planning. Have you got wills in place? Really important, something that clients do put off. Perhaps they don't want to think about it, some difficult decisions to make. obviously the structure of the wills is going to really depend on the client's circumstances, what they want to achieve. Tax is always going to be one thing they are concerned about, tax efficiency, but it's not the only concern. And for high net worth clients, the sort of clients who are setting up family investment companies and doing other planning, we are usually recommending trusts within their wills. So they might still have trading businesses, they might have interests in businesses that would still get business property relief for inheritance tax. So we'd be recommending that anything like that goes to a discretionary trust. You don't want it going to a spouse, because if the assets are then sold, they're within the spouse's estate on death and taxed at 40%. So you want those business property relief assets passing to trust when they get the relief, and then when they're sold, they're within the trust wrapper. We're going to come on to talk about interest in possession trusts for spouse on first death and discretionary trusts as well. So on first death, where does the residue go? Does it go to the spouse directly, or does it go to a trust? Obviously, leave it to the spouse direct. You do get spousal exemption from inheritance tax. The surviving spouse is in complete control of those assets, which is an important consideration. And people feel quite strongly about losing, control of things. However, the survivor could change their will. If you've got a relatively young couple, if one of them dies quite young, it's likely they may form another relationship. They might get married. If they remarry, that revokes a will. So they might not even mean to revoke the will. So there's no protection there for the children, which is normally what people are concerned about. So the other option is to leave the residuary estate to an interest in possession trust. So with this, you are giving the surviving spouse the right to income. That also translates into a right to reside in any property. And you will get spousal exemption on anything passing to that trust, because the spouse is what we would call the life tenant. They are the income beneficiary. The trustees are the people in control. Sometimes the spouse is one of the trustees. That might, make them feel a bit more comfortable that they are involved, they are in the conversation, they have a say in things. But you're protecting the capital for the children or other, further descendants. The tax treatment of this sort of trust, as I say, you get the spousal exemption when it goes in on the first death. On second death, the assets are aggregated to the survivor's estate for inheritance tax purposes. So you're not getting away with paying any inheritance tax. However, if the spouse decides during the life of the trust that they don't actually need all of the income, perhaps they've got other assets of their own, they might have other things going on, they don't actually need all the income from that trust pot, they could give some of that away to the children early, and that would be a gift from their estate, and if survived by 7 years, it will be outside of the estate, and it won't be aggregated and taxed upon the second spouse's death. You can build in additional powers for the trustees to pay capital to the spouse, so it doesn't mean they can never get any capital. If appropriate, then the trustees may be able to pay capital to them, and they might be able to pay capital to children early, as we've said. These sorts of trusts are particularly important when you've got second marriages, children from different relationships, and you're wanting to protect capital for the respective children. But there can be an unfair tax implication where you've got perhaps different size estates because of the way the assets are aggregated and the nil rate bands are used again for tax purposes. So that's just something to highlight, because it's something we will look at. We'll do the calculations at the time. And as I've said, you can give the money out of the trust to the children early if you want to. So that's on first death. On second death, we would usually be recommending that you leave your assets to a discretionary trust rather than to children directly. So, as I mentioned at the beginning, with any trust, you're separating out that legal and beneficial ownership. The trustees are the people who are in control, and that's very much the case with a discretionary trust, because it is at the discretion of the trustees what happens to the assets. So who your trustees are, really important. With a discretionary trust, you'll have a class of beneficiaries. So it's a group including the children, further descendants. There may be other family members in there. Some people put charities in there. It's important that you have a group of beneficiaries and you're never left with just one beneficiary. Otherwise, you lose all the advantages because there's no discretion, it's just one beneficiary. Because the assets are, they can only be used at the discretion of the trustees, and the beneficiaries have no automatic right to the assets, it means that the assets are not inside their estate, and that is where all the advantages lie. Not inside their estates for many reasons. So if a child gets into money difficulty, becomes bankrupt, perhaps you're not sure if they're particularly wise when it comes to making financial decisions, they don't actually own the assets. It also might suit the children to have the assets in a discretionary trust and not in their own estates. They may go on to be successful in their own right, they might have their own businesses and become wealthy, and if those assets are inside their estate, they're going to be taxed upon their death. It might suit them to have them in a separate trust wrapper, and they can use those assets to benefit their grandchildren and further descendants. These trusts can really be used to pass wealth down generations, so that's why they are popular when you're doing family investment companies. The assets, as I say, are not inside the children's estate, so that brings lots of benefits. Choice of trustees, as I say, really important because they are the people in control. You don't have to have professional trustees, you can have lay trustees, but if you're talking about very large figures, and given the complexity surrounding setting up trusts and managing things, most people would want professionals involved, or at least independent trustees. That people do fall out, children fall out, people have different opinions on things, and there can be a bit of a risk there. So if you've got professional trustees, or at least independent trustees, you know that they're going to do what's right for the family and for the trust. We do have a trust corporation, and we are often appointed as trustees for people, executors and trustees, for this reason, really. It also takes it out of the children's hands in that you're not giving them the burden of having to manage it all, and they're going to have to get professional advice anyway. It's important to get a comprehensive letter of wishes in place so that your trustees have some guidance, an idea of what your thinking was when you were setting up these trusts. So in that you can put anything you want, really. So it's not legally binding, but most trustees would follow it. It might be things to do with what your thoughts are on looking after the children, especially people who have young children. You're going to want the trustees probably to pay out towards university fees. You might want them to pay out towards helping them on the property ladder, things like that. So you can put all that in your letter of wishes. Trust compliance, there is a lot of trust compliance. It has to be registered with HMRC. So as I say, even if you have lay trustees, it's wise for them to get professional advice because they don't want to be tripped up by all these rules. You can, of course, put other gifts in the will, so people might decide they want to give specific items or cash legacies to people, and charity legacies. If you're giving gifts to charity, they are exempt from inheritance tax. And if someone is already giving quite a large amount to charity, they might decide to look at giving over 10% of their estate, and then the tax rate on the taxable part of your estate is reduced to 36% instead of 40%. So that is just something for people to know about, if they are considering giving charity gifts. And then just a couple of last points. Everyone thinks about protection on divorce. Yes, trusts have their place. It's better to have things in trust than in people's individual names. But matrimonial courts have really wide powers, and there have been cases recently where they have looked at trusts, they've taken them into consideration, and you can't guarantee that a matrimonial law court won't look at a trust and try and break the trust. So the best protection is pre- and post-nuptial agreements. I know they're not very romantic. My advice is to people to have those conversations early. If you're in a wealthy family, children are forming long-term relationships, it looks like it might be going down that, route. Have the conversation early, plant the seed early. What goes wrong is when people get engaged and it's like, oh yes, we're engaged. Let's open the champagne. Can you just go and see a solicitor about this prenuptial agreement? It doesn't go down very well. Takes the romance out of it. But it's really important. If you've built up wealth over many years, you don't want it disappearing on divorce. Importance of tax advice. Obviously, we've teamed up with Forbes Dawson here today. It is really important to get tax advisors involved when you're dealing with high net worth clients, but professionals generally work with financial advisors as well. It's important that all the professionals are on the same page working with the client. And I think that's about it now. So I'm going to open the floor for questions. You can direct questions to all three of us. Any questions?
Wow. Stunned into silence. No one? Okay. We are going to hang around anyway, so if you want to have a chat with us individually and ask any questions. Oh, got one. Let's start it off.
If you've already got a fixed setup, which is on the basis of shareholding with parents and children, does that need to be scrapped if you want to change it to so that trusts are involved in the ownership, or can you mould that to be remodeled so that trusts can be brought in to be owned?
I'll mention the tax point. If it's got value in it already, it's very, very difficult then to move it because
Given the stock market for the last 12 months, it's got negative value.
the problem you've got is that the mum and dad should be the settlers of the trust, and if the children already own the shares, they can't settle those shares. What you could do is probably issue a new class of shares, as long as there's no value, and then mum and dad could transfer those into trust. Changing terms of shares is not ideal partway through, but if you're doing it on the basis there definitely is no value, then it's possibly okay. It's doable if you get tax advice on how to do it and legal advice on how to structure those terms. I'll let Scott.
I think the biggest risk, as Laura points out, is anything you do to vary the rights or bring a new class of share in which shifts value will trigger a tax liability, and no one wants that because it may not be the cash in the business in order to, or in the family investment company to cover it. It may also be easy to start up a second family investment company with those assets, with those trusts in place, and just run them parallel, and then maybe wind up that later one as and when the time comes right, and then just move assets across at that time.
If you made a loan to the FIC in the first place, you could take the loan back out of the FIC, put it into a new trust.
Into a new company, yeah,
Possibly.
yeah. You just have to look at the value and make sure you definitely haven't got any value. That's the thing, but it's doable if in that case.
Are there any tax advantages, for example, if you have a partnership that each partner to set up an FIC, and upon crystallising the profits and paying the corporation tax and then taking it up to the FIC, you said that the parents, mum and dad, can't take out any capital.
No, obviously you can structure the FIC however you want. We've just done that on the basis that we're talking normally about people who have significant wealth. They don't want any more growth, therefore they don't want to take anything out of the business. Are you talking about incorporating a partnership then? Basically, each individual partner is going to become a member or a shareholder in that new company.
So holdings, separate FICs, and then therefore one partner might want to extract their funds, one might want to leave it in there, but it allows them to more tax efficiently manage their own profit share.
Right. So you set up a family investment company, with no value in at the start, or
Correct. Well, so the holding company, let's say, can crystallise
What's the holding company? You mentioned partners before, I'm not quite clear on. So you've got partners, you said?
Yeah, 2 owners, sorry.
So you talk about holding a company with 2 shareholders?
Correct.
All right, okay.
And then each shareholder sets up an FIC, and then after you pay the corporation tax, you take each profit up to the FIC. The question is it more tax efficient to do it that way and extract their capital from the FIC or invest it from the FIC, as opposed to extracting it from the holdings company as each shareholder?
It's the length of time, isn't it?
Yeah. Is it holdco with FIC underneath?
Yeah, I think if you look, it's cash extraction versus holding, isn't it? Is what you're talking about. And a FIC is not designed for cash extraction. You'd probably want to do that step first, extract your cash at that stage, and then for the person who then reinvest it into a FIC afterwards, because you've got the loans. The issue I think I'd have, you've got an existing asset, haven't you, which you're then putting with value, and you're trying to put a FIC on top of it. So you might have value in that. So I think the idea might, and if there is a mixture of cash extraction versus holding, I think you'd want to extract the cash out first and then reinvest that by way of loans into the family investment company structure.
Can I ask a question? Are you basically talking about having a holdco on top of an existing company, a separate holdco for each individual person?
I'll get into specifics. Holdco.
Yeah.
SPVs underneath the holdco.
So trading companies are just property companies?
Property.
Right, yeah, okay, yeah.
Each individual project is
Yeah.
it goes
Yeah.
into holdco.
Yeah.
Let's say holdco reaches, let's use it in simple terms, £2 million.
Yeah.
You pay your 25% corporation tax,
Yeah.
then each director wants to then take it to their own holdco.
Yes.
As opposed to then 2 million minus 25%, as opposed to then paying another 45% on income tax or dividend tax, whatever you
Yeah.
take it.
Yeah.
Can we move that up to the FIC
Yeah.
and invest it from there?
Yeah. So basically what you'd said is you are having a holdco for each individual person on top of their existing holdco. So it's like a separate investment company for each individual member. Yes, you can do that. And then all that's doing, though, is it's separating out the profits for that individual. So as you say, shareholder number 1 may decide to take all his profits out as a way of dividend up through his FIC. Shareholder number 2 may decide to keep it in his holding company, his FIC company, and therefore is not paying that dividend tax. That's only really useful, isn't it, if they want to do different things and they're concerned that one of them's taking money out and one of them isn't, if they're not family members, for example. So you're talking about shareholder 1 and shareholder 2 not being family members. Because if they're family members, you're not bothered about one person taking some money out and one person not. If they are just in it for commercial reasons, then you are more concerned about, oh, well, he's taken all the dividends out and I've still got mine to take and I've not taken them.
But there could be a second layer of tax.
No, because if it's a dividend to a company, it's exempt. So it's basically like a typical holding company structure, isn't it?
One caveat on that is banks won't like that structure. If you've got a trading company and you're using SPVs, borrowings, etc., they won't like the complexity at the top. Get banking for family investment companies. A few banks out there that will go, yeah, it's fine, we'll deal with it. But your traditional high street banks won't. So anything that's slightly quirky, they're probably going to avoid it. So just from a commercial point of view in practice, you probably want to just keep things simple. Maybe take some of the cash out from those holding companies and lend that into a separate FIC or extract it one way or the other. But with this, it's all a balancing act. And when you've got existing trading businesses as opposed to investments, you've got to be very careful.
If you've got a lay trustee and you want to move to a professional trustee, is that easy to do to establish the?
Yes, the lay trustee can step down and you can retire the lay trustee and appoint professionals. Yeah. You'd always have more than one trustee, to be clear.
Two, yeah.
You'd have at least 2.
So we have a trust form, but we came today because we wanted to see if we'd be given the best advice. So we'd like to speak to you outside of this. I'm sure many other people would. If we find that we haven't been given the best advice, do you think it's possible to change?
Yeah, there may be things we can do to, it might not be winding up the trust, but it might be that you can make some amendments, yeah.
And if
Depends on the
If
circumstances.
you set up a trust and you've got some loan to the trust, some structure that you discussed before, and then we choose to move abroad to say, Portugal or wherever, does that affect or have any impact on the trust?
I think the main point is where the trustees are, isn't it?
To residents.
For residents. So you'd want trustees in the UK. Yeah.
How wide is the definition of family? So if you've got a couple that were married children and then somebody sells a business, this is after open vote. How wide is that definition?
Do you mean for family investment companies? Yeah.
As wide as you want it to be. You can define them, you can have, it's all about who gets the benefit of it, and after that, who wants it. So whoever's settling it, whoever's putting the money in the first place, they get to decide who benefits from it. So it's normally a family. Yeah, you can do that. We just need to sit down and make sure that the class is there, but obviously the wider it is, the harder to control it. But yeah, there are families that don't have children.
I mean, just to be clear, a family investment company is not a particular type of structure, it's just a company. And the shareholders are whoever you want them to be, so it's as simple as that, really.
There any indication from a political aspect of the other change of government as to if this will become a less favourable structure?
Well, we can only, obviously we don't know, is the honest answer, but we know that recently we've had hikes in corporation tax from 19 to 25%. We've had the increase in dividend rates by 1.25% that was alluded to being national insurance to be equivalent, and that's never been taken away despite national insurance being reduced. So we've already got a tax on a company structure and extracting. So it's going to be very, very hard on the companies and the shareholders if they do make further changes. I mean, no, overall income tax rates might increase, so we just don't know that. But it would, I don't know, is the honest answer, but that's my thoughts.
There was a review about a year, 2 years ago into family investment companies. HMRC, the government had a general review, and they basically, the answer was individuals that set up family investment companies will pay their tax. So it's not, there's no concerns around the structure. We're not doing anything here which is loopholes. It's just amalgamating different company loans, trusts in a certain way to maximise the most efficiency out of the tax rates we have at the moment. To try to legislate for this kind of thing is going to be very difficult, unless they make an absolute mess of it. But yeah, so far, and as I say, this is just a name that came into these kind of companies. It's just an investment company. They've been going for tens of years. There's some investment companies I've been dealing with back in the 1940s, 1950s, exactly the same structures, just don't have this name. So it's just a closed investment company, as you said.
What the revenue did say is that they will investigate those very complicated structures where the terms of the shares are not commercial. So, which is why we keep it as simple as possible by having voting rights on all the shares. Don't have any funny, strange terms that somebody can get a dividend when they're over 25 and not if they're over 35. It's just a simple company, and then there's no way the revenue can attack the actual structure of the company, and the tax then follows the company structure.
So if loans are taken out of the FIC by beneficiaries, you said you've got to have that immediate repayment on.
Repayable on demand, yeah.
Do you have to on demand, yeah. So do you have to have a provision in place for that?
For what happens to the loan, you mean afterwards?
Yes, if there was a demand for it to be recalled.
Well, I mean, it's a family, isn't it? So I think mum and dad, the whole purpose they've set this up is to create growth and generate growth. They're in control of what happens in the company anyway. So if they wanted £500,000 back, they would just direct their investment advisors, sell some investments to get the £500,000 back. So it's as simple as that, really.
Yeah.
No, and it's only mum and dad who can call on loan, don't forget. It's their loan. The children can't call on that at all.
And then do they have to pay benefit in kind?
No. No, because they're lending the money to the company.
No, the other way out. So those that are taking the loans out of
Nope.
it.
No, well, we don't recommend people take loans out. They're being repaid, their loans. The capital is a repayment.
It's about loans from the FIC to individuals.
Yeah. So say you set up a FIC and
Yeah.
then a lot of money and capital available for their children to then buy houses, etc. So they
Yeah.
come out of it.
Yeah, we wouldn't normally recommend that loans are made out. So this is family investment companies, normally something that's run alongside the rest of the estate planning, where we'd be having things like trusts that would be set up for things like buying properties, or there'll be capital cash gifts made for buying properties out of their own cash. So we don't always recommend that mum and dad put everything they own into the FIC. We have a hybrid of keep some cash back for family circumstances, keep some cash back for your own investment, put some in the FIC for investment for your children. The FIC is not used for capital amounts for the children. That's what we use trusts for, or capital cash gifts. So it's dividends only for the children, and to accumulate that growth in the company for the longer term. Ultimately, on winding up, they can get huge amounts of capital out, but it's really to provide an income for them. What might happen, though, if some of these FICs are set up with 30, 40 million in certain circumstances? So mum and dad might think, well, I don't know how much I need to live off, and they'll put 30 million in, And then they'll get to age 70 and think, well, I don't need all that loan. I've only taken 10 million back. I'm going to give that loan away to my children. And they can do that without capital gains tax. They need to survive 7 years from making a gift, but then that is a loan that the kids can draw down for that purpose, as you've said.
Does it have to be classified as a loan, or could you make an investment so what mum and dad extract out is worded as interest?
Well, you normally want it as interest because it's quite tax efficient to get interest out. As we said, 25% deduction, low rates on mum and dad. No, we don't want any other type of money coming out to mum and dad, normally because they're wealthy enough as it is. And capital loan repayments are tax-free anyway, so there's no real better way of doing it.
For personal beliefs, it can't be worded as interest.
Why would you not want it worded as interest?
It's a religious belief.
Oh, I see. Right. Okay. Yeah, you can do that. So yeah, I think you can do the Sharia law type of investment. Yes, you can do that. Yeah, you can.
Just grab that.
Yeah.
I think the point making there is making sure the balance. So when you do come into the cash, you sit down with your financial advisor, and maybe the odd one or two in the room, I've spotted, to make sure that you are doing this planning. So any cash that you don't want to be liquid goes into the FIC. That then invests in illiquid assets, property, shares, etc., that aren't easy to sell. And then you have these cash trusts set up separately for these other gifts. And then you have whatever you need for the rest of your life. That clever piece of technology that tell you how much money you need till you die. So, I don't know how that works, it's magic. So you can work all that out before, and that way you know how much money you're going to put in, how much cash you've got spare to go into the family investment company. There was a question at the back from a lady. You still got it?
We're talking about family investment trust. If you created, say today I created a family investment trust, and I've got several properties, and I've put those properties into the trust, they're all already got a value, haven't they? What's the tax implications of that?
Well, there are some ways you can get properties into a company. Unfortunately, there are significant tax implications of doing so. If you are an individual owner of property, then typically most people don't want to do it because you're going to have stamp duty land tax payable on the market value of the properties, and on residential that's at the 3% surcharge rate. You're going to have a capital gains tax disposal into the company as well, at 24% on residential property now, or 20% on commercial. So you basically got some upfront tax considerations. If you're in a partnership and you're running it as a rental business and have been doing for many years, and you actually actively manage that business, let's say you've got 10 properties and you're actually doing that as your main business, there are ways you can incorporate and get tax relief on doing that. But that's a whole sort of piece of tax work you need a lot of advice on. So it is possible, but only in certain circumstances. You can do it, but you're going to be paying tax up front to do it.
Very specific question on the 10% substantial shareholder exemption. Do the shares have to be voting shares?
They have to be ordinary shares. Yeah, so they would be voted, yeah.
They have to have voting rights.
I believe so. I'd have to check with my corporate colleagues. Is Tim still here?
No, he's gone.
Oh, maybe Adam might know. Adam, do you know? Adam's looking around the room as if he doesn't know. I think so, yeah. I can get back to you if you want on that, but I believe so, yeah.
Okay.
Yes.
Of course.
You say that if you have various trusts, and you have 10% in each trust.
Yeah.
And we discussed about the £325,000.
Yeah.
That only applies to one of the trusts.
Well, the benefit, I'll explain technically how it works. If you were to set up a trust with £325,000 in at day one, yes, you're right, you only get that allowance there and then. But technically the way the system works is that if you set up trust one with £10 in, which is what we're saying we're doing with these shares, when you come to the 10-year charge, so you've got £10 in trust one, and you put £10 in trust two, £10 in trust three, they happen to grow to, let's say, £500,000 at year 10. What you do when you're assessing whether the nil rate ban is available is you say, trust one says, has this person set up any trust in the last 7 years? No. So I've got £325,000 available to trust number one. They go to trust number two and say, what transfers have been made in the 7 years prior to this trust? Well, only £10 was put into that trust at day one. So it's only £10 out of your £325,000 that you lose in trust number two. And it goes on and on and on until you've lost £20 in trust three, £30 in trust four. So you actually get more or less £325,000 in each trust. Yeah, that's only if you do it a certain way, set up on different days, shares settle on different days. There's a very prescriptive way of how you have to do it. But this is known as the RISAF case, and it was a case that the revenue lost. As long as each trust is different and set up on different days, you should be fine with that. No, there's 325,000 for each trust, less the £10.
Sorry, so there's £325,000 allowed in each trust.
Less the £10. Less. Yeah, less £10, less 25.
Are you saying if you had 10 trusts, you've got 3,230?
Yeah, 3.25 million less £90 in the ultimately, yeah. Okay.
Got it?
Yep.
Yeah.
Yeah.
Yeah, so we're going to be hanging around, so any more of those excellent questions, you can come grab us and ask. Quick favour for you, you'll have feedback forms in the packs of papers on your seat. Please feel free to give feedback, but more importantly, there's going to be another seminar in June, I think it is. We're going to go backwards, so we've done what happens after your exit. We're going to go to the before bit next. Pre-succession planning, pre-exit planning, so what you want to kind of be thinking about on the run-up to your sale of your business. Please feel free to put questions in there, anything you want us to talk about in that to help us structure that one. And then finally, thank you. Thank you very much for coming, and say we'll be hovering for coffee.